Guys, today, Friday, I'm working from my bedroom, and I am thinking of selling a few cover calls with expiration the following Friday. Okay, so we're looking at 7 days away, and I am in the specifics thinking about three of my positions. One of them is TQQQ. The other one is Pfizer, which is up nicely today. And the other one and the last one is PG&E. Stock ticker is PCG. But I also want to see what Gemini is thinking about what I am going to do. So let's go on Gemini, which in my opinion is the best AI app. Let me see. What do you think about selling cover calls on TQQQ slightly in the money?
Selling in the money, ITM, covered calls on a 3x leveraged ETF like TQQQ is a bold, high conviction move. It essentially turns a high octane growth engine into a defensive, income focused play. While it feels like a way to slowly extract cash, it fundamentally changes the nature of why people hold TQQQ in the first place. Here is a breakdown of how this strategy functions and the risks you should weigh. 1. The mechanic, defensive income. When you sell an ITM call, you are selling the option for a strike price lower than the current market price. Intrinsically bearish/neutral. You are essentially betting that TQQQ will either stay flat or decline. If TQQQ goes up, your shares are almost certain to be called away at the lower strike price. The buffer. Because the call is ITM, you receive a much higher premium than an out-of-the-money OTM call. This premium acts as a significant downside cushion. If TQQQ drops by 5%, the premium you collected might offset that entire loss. 2. The leverage conflict. The biggest philosophical hurdle with this strategy is the 3x leverage. Capping the upside, TQQQ is designed to capture explosive 300% daily moves. By selling ITM calls, you are capping your profit at the strike price plus the premium. If the Nasdaq rips 4% in a day, meaning TQQQ rips 12%.
Well, I don't think it says anything insightful, but let me go and pull up my TQQQ position, and I want to see a couple of things. Now on the TQQQ, I have about 500 shares, carrying it at about 53 and a quarter. 53 and a quarter. It's trading at just shy of 54. So let's say that I already have 60 cents of equity a share. I got 60 cents a share. Let me go and look at the option. For TQQQ quote details. Now it's down nearly 4.5% today. I wouldn't say that we're having a market sell-off, but market is down. I think the S&P 500 at some point today was down 1%. Let me see under the option tab. Let's go 1 week out. Okay, if I was to sell a cover call in the money at 53.50, okay, so if those shares are gonna be called away, I'm gonna profit 17 cents from the share appreciation, okay, and possibly $2 a share for the premium. So it's a win-win situation where I'm going to protect my downside. I am going to profit. So once again, 17 cents a share and a couple of bucks premium a share. So you're looking at $2.17, 53.50. Let me see what I got here. $2.17 divided 53. Wow, this is going to yield 4%. 4% on my money in a week. So if I was to rinse and repeat this for 50 weeks of the year, I am going to make over 200% on my money. Now, of course, it's not that easy. It's simple, but it's not easy. And the way I say that is because, of course, sometimes the shares are gonna be called away. Sometimes the stock is gonna drop, where you're gonna, yeah, collect the premium, but you are going to lose on the share price. But because I'm only focused on the premium and on the income, I'm okay with that. So I think I'm gonna go ahead and do that. Expiration February 6th, 53.50. I am going to head on here, trade options, sell to open, 53.50. Let's see. Okay, it dropped a little bit, but anyways, I'm gonna go ahead and do this market preview, place order. Okay, it appears that I'm gonna have 178 bucks, nearly 50 cents deposited in my account, and now that amount might change. Depends on exactly the price that the option was sold. But regardless, I'm gonna go back and check that on at a later time. But anyways, I believe that 4% on my money, it is great, 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 great. I mean, nearly 200 bucks of income to keep my shares tied up 7 days. It is just great. So let me go back on portfolio. I am going to check my other position that I was gonna sell cover call against it, which is Pfizer. All right, let me pull up Pfizer. I believe Pfizer it is an undervalued stock. It's paying nearly 7% dividend, and the stock price hasn't really done a lot after COVID. Now on Pfizer, I'm up. I'm having an unrealized gain on nearly $100. I have just over $8,200 in this position. Total gain of nearly a percentage and a quarter. And I am carrying those shares at, let's say, $26 a share. On this one, I have 311 shares, which I think 200 of those they're already tied up in two other cover calls. So I can write today a cover call on Pfizer, one contract, and I think I'm gonna go ahead and do that because I already got equity 26. I'm carrying it today. Is trading at let's say 26 and 38 cents. Let me go back and ask Gemini if I was to write a cover call option 1 week out. So guys, watch this. If I was to write a cover call 1 week out with a strike price of 26, yeah, I'm going to lose 6 cents a share, but I'm gonna make let's say 70 cents a share. So for a total profit of 63. Why, guys, 63 cents a share. 63 cents a share. If I was to go back here, 63 divided 26. This is 2.5% yield on my money over a week. So once again, if you can rinse and repeat this for 50 weeks of the year, this is going to over double your money because you're gonna have 121 return on your money. Well, I don't know where you can find another investment like this. Now, of course, again, in the same case as TQQQ, no, it's not really that easy because anything can happen to the stock price. But I think it's a good risk reward. Also because Pfizer is a pretty stable company. They have a few milestones in 2026 for FDA approval. And I think I'm gonna go ahead and do the What is your takes about selling cover calls against Pfizer stock ticker PFE slightly in the money today?
Selling slightly in the money, ITM covered calls on Pfizer, PFE, is a much more defensive income play compared to the high stakes TQQQ strategy we discussed. Since Pfizer is a slow moving, high yield pharmaceutical giant, this move signals that you are prioritizing capital preservation and immediate cash over any potential price appreciation. Here is the breakdown of the trade as of today, January 30th, 2026. 1. The current context. PFE. Price. Tilde $26.40. Up about 1.2% today. Dividend yield. A massive 6.5% to 6.6%. Analyst sentiment. Mostly a hold. The stock has been consolidating in the mid-$20s for a while, with targets hovering around 28 minus 30. The slightly ITM setup, selling a $26 strike with the stock at $26.40. 2. Why this strategy is attractive for PFE. Unlike TQQQ, where you want to capture moonshots, Pfizer rarely moons. It's a value stock. Downside cushion. The premium for a $26 strike will be quite rich. If PFE drops from $26.40 to $25.50, your total position might still be flat or slightly positive because of the fat premium you collected. The double dip risk. Pfizer just went ex-dividend on January 22nd. The next dividend isn't payable until March. If you sell a call that expires after the next ex-dividend date, you risk the shares being called away before you can collect that approximately 6.5% yield. 3.
Well, it's not our case because I'm gonna write it out to February 6th, which is a week from today. So the dividend is not gonna worry me.
Strategy trade-offs. Feature, impact on PFE position, probability of profit. High, you are starting with a head start, the premium, and the stock doesn't need to move at all for you to make money. Upside cap, very tight. If PFE finally has a breakout to $28 on good drug trial news, you are stuck selling at $26. You miss the rally entirely. Assignment risk. Significant. Since the strike is below the market price, there is a very high chance you will be forced to sell your shares at expiration. My grounded peer perspective, selling ITM calls on PFE is essentially saying, I don't think this stock is going anywhere, and I'd rather have a 1% to 2% guaranteed rent payment for the next month than wait for a 5% gain that might never come. The warning bell for Pfizer. Watch out for early assignment. Because PFE pays such a high dividend, call buyers sometimes exercise early to capture the dividend themselves. If your strike is ITM, you are the prime target for this. Is this a forever hold for you, or are you just trying to milk some cash out of a stagnant position? If I know your goal, I can help you decide if a neutral.
Well, I think I'm just gonna try to milk the cow a little bit, and I'm okay. If the stock was to go up and I'm gonna lose the potential appreciation, I'm okay with that. So I think I'm gonna go ahead and do that. Let me go back here on Pfizer. Today is up 1.25. Once again, I'm carrying it at 26.06. Okay, 26.06. This is February 6th. Expiration, trade option, sell to open. Okay, this is gonna put at least 60 cents a share in my pocket within 7 days. Select pricing. Okay, I'm gonna put here market good for the day. Everything looks good. Let me double check. Yeah, February 6th. 7 days away. I'm okay having my shares tied up for a week. Dividend is not a problem. I'm already going to collect the dividend because I own those shares long term. January 22nd was the ex-dividend day, and I'm gonna collect the 7% annualized dividend regardless. So I'm gonna go ahead and place this. Now this is gonna put nearly 66, possibly a little more. I'm gonna have to double check the payout amount later, but place order. Okay. Guys, it doesn't seem like it is a lot of money. You're only talking about possibly within 65, $70, but you're only talking about keeping your shares tight for a week and $70 over a 2600 investment, like I already did. But I mean, you're looking at 70, let's do $70 over a 2600 investment. Again, you're looking at over 2.5% return on your money in a week. The next position that I was gonna do the same trick again is PG&E. Let me see if I can pull it up. PCG. Now on PCG I have over 6,100 invested. I got right at 400 shares, and I already have 2 contracts of cover call. Okay, one that expired February 20th and one that expired March 20th. So what I'm gonna do today, I'm gonna sell cover calls, I'm gonna sell 2 contracts, and this is similar to what I've done with Pfizer, because I have equity built in it. I'm carrying those shares at 14 and 3/4, and today is trading over 15 and a quarter. So let's see, I have about 50 cents of equity. 50 cents of equity each share, which is trading at about $15 a share. So let me go back at the option and look at quote details. Options tab. So now guys, I'm carrying it at 14 and 3/4. I think the best thing to do here is going to February 6th, and strike price I'm gonna pick 15 bucks a share. Now in that case, I'm gonna profit about 25 cents a share and 45 cents a share of premium. You're looking at 70 cents a share. Now guys, 70 cents a share on a share price of 15. What is that? $70, 15. Guys, this is nearly 4.5% on my money in a week. Too good to be true. If I can repeat this 50 weeks of the year, I'm gonna have a return on investment of over 230%. Okay, said enough. Now, of course, anything can happen. Let me go on Gemini, and I wanna ask Gemini what it thinks about my next move. What do you think about selling cover calls slightly in the money on PG&E, ticker PCG, 1 week out?
Selling slightly in the money, ITM, covered calls on PG and EPCG with a 1 week expiration is a classic income harvest play. But it's particularly interesting right now because of how the stock is behaving today, January 30th, 2026. With PCG trading at roughly 15.33, a slightly ITM call would likely BE the 15.00 strike. Here's why this specific setup is a double-edged sword. 1. The strategy, the $15 safety net. By selling a $15 call when the stock is at $15.33, you are essentially agreeing to sell your shares for a discount in exchange for a fat upfront payment. The 1 week edge. At a 1 week expiration, time decay, theta, is at its absolute fastest. You are essentially getting paid to wait out 5 trading days. Downside protection. The premium you collect for a 15 strike will BE roughly asterisk 0.40 minus 50 cents, intrinsic value of 0.33, plus some extrinsic time value. This means PCG could drop TO 14.85 before you actually start losing money on the week. 2. The dividend trap happening today.
Dividend is only not even a point and a half, so I'm not too worried about the dividend.
Today, January 30th, is actually the ex-dividend date for several of PG&E's preferred shares. While the common stock, PCG, has a smaller yield compared to Pfizer, it still matters. Early assignment risk. If you sold these calls yesterday, there was a high chance of being assigned early. The price drop illusion. On ex-dividend dates, a stock price often drops by the amount of the dividend. If you sell ITM calls right before this, you might wake up to a lower stock price, but a winning option trade. 3. PCG performance versus outlook. Metric. Status. Current price. Tilde $15.33. Up approximately 1.1% today. Volatility. Moderate. Approximately 31% minus 37% IV. This is high for a utility, which makes the premiums juicier for sellers. Analyst view. Strong buy. Many analysts have price targets at $21 plus. My grounded peer perspective. Selling ITM calls on PCG 1 week out is a low beta, high probability way to manufacture a dividend, even if the company doesn't pay a large one. However, you need to be okay with losing the shares. The bear case. If you think the wildfire risk or regulatory pressure in California is going to keep PCG suppressed in the $15 range, this is a great way to clip coupons. The bull case. Analysts are calling for a massive move to $21 this year. If you sell a $15 call and PCG suddenly jumps to $16 next week on some positive legislative news, you are locked in at $15. You'd be kicking yourself for missing a 5% gain.
I'm okay with that because it's speculation. No one knows what the stock price is gonna do, and you're talking about 1 week out. The thing with the wildfires, now they have a $40 billion insurance with the state of California, and this is February. Okay, I think 1 week out, I'm just gonna be fine, and I'm gonna go ahead and do that.
Just to collect a 2% premium, would you like me to calculate the break-even price for a specific expiration date next week so you can see exactly how much protection you're getting?
Well, guys, I think I'm gonna go ahead and do that. A couple of contracts on PG&E. Expiration February 6th, 7 days from now. So where am I? 15 strike price. Trade options. Sell to open. This is gonna put again whatever it is going to happen, 70 cents in my pocket a share over a $15 share price. So it makes sense. Okay, everything looks good. The bid and ask spread is acceptable. Market good for the day. Preview. I forgot to two contracts. Okay, this is gonna put about $90 in my trading account deposited today. Placeholder. Okay, we're all set and good to go. So as I was saying, guys, I placed three trades. It took me about half an hour. I'm working for income, and you can do it too. All you need is an internet connection. You don't even need Wi-Fi. You can work with data, and I'm doing it right now straight from my bedroom. So this is a great way to generate income, a weekly income, protecting your downside, and make a huge return on your money. I would say that I can conservatively double my money every year if you can rinse and repeat every week. You gotta stay solvent, you gotta stay consistent, and you gotta pick the stock positions which you already have a little bit of equity built in it. So you're gonna profit on the equity side and on the premium side of things. Now, if the stock pays the dividend, again, you're gonna be careful to do this around the ex-dividend dates. And generally speaking, you are going to be careful around the earnings date. Now, like you guys know, I sell a whole bunch of covered calls against Verizon. And of course, I collect the premium. I generate great income with Verizon. But Verizon was up at some point today, I think 11%. So I gotta go back and check on my strike price on Verizon and my expiration date, because I think some of those shares are gonna be called away from me. But regardless, I'm gonna collect the dividend on Verizon, which is a pretty hefty dividend. In fact, let me check right quick. What is Verizon doing today? Verizon is trading up. It's trading up nearly 11.5%, which is huge for a company like Verizon that doesn't move much. Look at that move. Year to date, that showed up over the past year. I feel very comfortable doing this with Verizon, with everything that they got going on. And now I do know that the cell phone provider market in the United States is very mature, possibly close to saturation, but it's a pretty stable company that pays dividends, and they've been doing it for many years, and the stock price is been in the same range many years. Over the past 5 years, over the past 10 years, it only moved at 13%. Over the past 30 years, really, it hasn't done much. So it makes it a great candidate to sell cover calls against it. I think their customers are pretty loyal to Verizon. There is a lot of competition The bad thing is that really is a race to the bottom because they're competing with AT&T, with T-Mobile, and other small operators that they are willing to drop the price to gain customers. But regardless, I think they have a good relationship with satellite internet, whether it's Starlink, and they can get their customers to sign for satellite internet that can be very helpful in rural areas, or if you're up on the mountains or you are on a boat. But I don't think that's gonna disrupt the main use of wireless customers. Once again, I am thinking that I've done very well for me today. Anything can happen to stock prices again, but that's why I pick those positions in order to mitigate my risk. If you guys think about it, PG&E has taken a huge loss in 2017, 2018, and recently everything that was going on with those wildfires. I think PG&E was a 60 buck a share, and now it's all the way down to 15. It is a great utility company operating much like a monopoly in Central and Northern California. They own the structure, they own the pipes, and they own the lines. They also provide the natural gas, and they operate like a monopoly. I feel pretty comfortable with that. Now anything can happen again, but if you can weather the risk, you shouldn't be in the stock market in the first place. So I talked about Verizon, I talked about PG&E, Pfizer too. It is a great stock. I think there is a lot of upside potential. It is a stock that it has been overlooked by retail investors, but pretty stable company, great balance sheet, dividend payers. And the other one, the triple leverage QQQ, of course, it carries a lot of risk. It carries decay. They charge you a high fee. There is the issue with a volatility drug. But anyways, it is connected to the QQQ that over time is only gonna go up. Okay, and I think the next Nvidia, the next Tesla, it doesn't matter, the next big story in the US stock market is probably going to be trading in the Nasdaq.